You know our housing market is bad when the only reason why the number of loan applications increased last week is because more people are moving from a 30-year fixed rate loan product to an adjustable rate mortgage or an ARM. That's exactly what's happening right now based on a new report from the MBA as home buyers are getting more creative in order to buy a house with a more affordable payment. I mean, what could possibly go wrong when you buy a house with a 5-1 ARM in which your loan is fixed for 5 years, then it becomes variable thereafter? I can only imagine what these home buyers are being told because this is a very risky loan product in my personal opinion, and I'll share that with you guys here in a little bit. I first want to share the report with you guys, and then I'll share some thoughts regarding this because this is alarming to me. This is from the MBA, just announced today, which is October 11th. And by the way, thank you so much for joining me in today's video. This is a very important one because a lot of home buyers are being told right now that don't worry about 8% rates right now. Just buy a house, get an adjustable rate mortgage of fixed for 5 years, variable thereafter, but that for the first 5 years, it's fixed. You can just refi after that. Or you can do a 2-1 buy down in which your rate decreases by 2 percentage points in the first year. The second year, it decreases by 1%. And then the third year, it increases to the prevailing rate when you bought the house. Some very risky loan products in my personal opinion. And again, I'll share some scenarios about why people are moving to these more risky loan products right now and the latest trends. But I'm just kind of frustrated by reading this report here. Anyways, let's just read on here. It says applications overall, which includes refis plus purchases, actually increased by 0.6% from 1 week ago. This covers the week ended October 6th. The refi index, which of course is a measure of the amount of people submitting loan applications to refi, even though rates are very close to 8%, actually increased by 0.3% from last week, but still down by 9% from 1 year ago. Meanwhile, the seasonally adjusted purchase index, which is an index which measures the amount of people submitting loan applications to buy houses, increased by 1% from 1 week ago, but still down by 19% from 1 year ago. According to Joel Kahn, who's the MBA's vice president and deputy chief economist, he stated the following here. While most mortgage rates increased last week, rates on ARMs or adjustable rate mortgages decreased, leading to an increase in the ARM volume. Not ARM volume, but this means there's more people submitting loan applications using an adjustable rate mortgage, and also an increase in overall applications overall. The level of ARM applications increased by 15% over the past 1 week, bringing the share of adjustable rate mortgages to 9.2% of all loan applications, the highest levels since November of 2022. I mentioned this in a previous video, what was this, yesterday, in regards to the report that was announced 1 week ago. 1 week ago, I believe their share of ARMs was around 7.2%, or actually it was very close to about 8%. That is more or less in the middle of the low we saw last year and also the high we saw last year. So the low regarding the share of ARMs last year, I believe that was in January 2022 at around 3%. And sometime later in the year, it increased to 12%. Now it's at 9.2%, the highest level since November of 2022. He added the 30-year fixed mortgage rate is at 7.67%. That was last week, the highest level since the year of 2000 and about 40 basis points higher than 1 month ago. So an increase of about 0.4 percentage points from 1 month ago. So about 1 month ago, the average rate was around 7.27%. He also says here that application activity remains depressed and close to multi-decade lows. It has been important to you guys because the current levels right now is more or less on par with the lowest levels in about 2 decades or more. So why did the number of people submitting loan applications increase for ARMs? And again, mainly the main reason why applications increase is because more people are flocking to an ARM and moving away from a 30-year fix. Very risky in my personal opinion. So according to the MBA here, the average contract interest rate, this is the interest rate that home buyers are getting based on their contract with their lender. For a 30-year fix with conforming loan balances, that's $726,200 or less. So a loan balance less than $726,000. That increased to 7.67% from last week. Last week, it was at 7.53%. This, by the way, is the average rate for people with great credit and also an 80% loan to value ratio, and also for points being paid as well, in the range of 0.75 to 0.8. So more or less, the average rate for people with great credit who are putting down at least 20% down or have at least 20% equity in their houses are getting a 7.67% rate for a 30-year fix. Look at this though, 5-1 ARM, that decreased to 6.33%. Therefore, by moving from a 30-year fix to a 5-1 ARM, which means it's fixed for 5 years, then it becomes variable thereafter. In other words, it moves to the current rate then, and then it adjusts one time each and every year. Because the rate is about 1.3 percentage point lower for a 5-1 ARM versus a 30-year fix, people are flocking to get a more risky loan product versus a 30-year fix. And by the way, just for comparison's sake, I did a Google search for mortgage rates today, which again is October 11th. Again, for people with great credit, a FICO score in the range of 740 to 759, you're looking at a rate of around 8.06% for a 30-year fix. According to Investopedia.com, the average rate today, again, for people with great credit is at 8%. If you're doing a refi though, you're looking at an average rate of 8.41%. Absolutely insane. So according to the Mortgage News Daily, of course, as of today, the prevailing rate is at 7.60%, a 2 basis point decrease compared to yesterday. And here's these other rates as well. So I want to share the rates 1 year ago very quickly. 1 year ago, according to the Mortgage News Daily, we're looking at a rate at 7.14%. That's only an increase of 0.46 percentage points over the past 12 months. That's not what I want to share really though, because I want to share how, really the reasons why people are moving towards an adjustable rate mortgage or a 2-1 buy down, and share some examples regarding how much that's actually going to save you during that short period of time when your rate is actually fixed. So when looking at someone buying a $500,000 home, putting 20% down, your loan balance here is $400,000. Your rate at 7.67%. That was the rate for a conforming loan balance right here, 7.67%. Based on that scenario there, your principal and interest payment would be $2,843 per month. Look at this though. When looking at the rate for a 5-1 ARM, again, 6.33% right there for a 5-1 ARM, you're looking at a housing payment of $2,483 per month, assuming putting 20% down on a $500,000 house. This means you're going to be paying about $360 less per month for that same house if you're looking to do a 5-1 ARM versus a 30-year fixed rate mortgage. However, though, keep in mind, this is fixed for only 5 years. Therefore, your savings is only $360 per month for the first 5 years. After that initial 5-year period, your rate becomes variable and adjusts one time per year. So let me just give you an example. Let's just say you buy a house, your rate is at 8% today. Your rate is going to be fixed for 5 years, but after that, your rate is going to adjust to current rates after that 5-year teaser period. In my opinion, this is very risky because after that 5-year period, will you have the ability to refinance into a 30-year fixed rate mortgage? Or will you be stuck with a rate that is variable and adjusts one time per year? By the way, it's anyone's guess what the current rate is going to be nationwide in 5 years. On top of that, will your income change? Will you have a job? Will you have the ability to refinance into a 30-year fixed rate mortgage? It's anyone's guess. What I'm basically saying here, there's a lot of variables at play here. And in my opinion, it's very risky to move to a adjustable rate mortgage to buy a house, simply because you cannot afford a 30-year fixed rate mortgage. If you can't fathom this payment of $2,843 per month, and instead you want to get a 5/1 ARM to decrease it to about $2,500, and that is affordable to you, I would say just wait and rent and continue to save your money because it's very risky. Having said that, it all could work out, right? You could get a short-term rate that's fixed. Then when it becomes variable, you might have the ability to refinance into a lower rate. But there's no guarantees. Again, it's very risky in my personal opinion. All this reminds me of 2-1 buy downs as well. So for example, in a 2-1 buy down, in your first year, your interest rate decreases by 2 percentage points based on the prevailing rate today. Let's just say your prevailing rate today is at 7.67%. Your first year, your interest rate would be at 5.67%. During the second year, your rate increases very slightly to 6.67%. So the first year, your rate decreases by 2 basis points, or 2 percentage points, I should say. The second year, it decreases by 1 percentage point. In the third year, though, it increases to the prevailing rate. So when you bought your house, the rate is at 7.67%. In the third year, it adjusts to that current rate. So let me give you guys an example. So assuming, again, buying a $500,000 home, your interest rate today is at 7.67%. So with a 2-1 buy down though, for the first year, your interest rate decreases to 5.67%. Your payment of principal and interest would be $2,314 per month, quite a bit less than the $2,844 it should be if you're getting a 30-year fixed rate mortgage at 7.67%. So again, during your first year, your housing payment would be just over $2,300 per month at the rate at 5.67%. In the second year, it decreases by 1 percentage point based on the prevailing rate when you bought the house. So in this example here, going from 7.67% to 6.67%, or to be exact, in the first year, it was at 5.67% and increased to 6.67%. So your housing payment went from $2,314 to $2,573 per month. And then again, in the third year, it increases to $2,843 for the remainder of that 30-year fixed rate loan. So again, just like the risk involved in an adjustable rate mortgage, I have the same questions as well. Will you be able to afford that increased payment after the first year, after the second year, and also in the third year and thereafter? It's anyone's guess. Your income could decrease, it could increase, you could lose your job, etc., etc. In other words, in my opinion, there's a lot of variables and therefore a lot of risk involved in getting to an adjustable rate mortgage or a 2-1 buy down, for example. But I can only imagine the advice that some people are given, just saying, hey, just get a 2-1 buy down or an adjustable rate mortgage. Don't even worry about it because you can just refinance when it becomes variable or when your housing payment increases. But of course, I would love to hear from you guys as well, though. Are you getting this advice from people? Please leave me a comment below with your thoughts regarding this as well. Thank you so much for watching today's video. I appreciate you, and we'll see you in the next video.